Hey, Mike Swanson, this has been a very challenging year for stock market investors, but not just them. It's also been an extremely challenging year for people who are safely diversified. And they've been watching their accounts go down and not really understanding what has been happening to them. And I want to really explain what is the number one most important trend going on in the financial markets. It's been going on really since 2020. We all pay attention to the stock market ups and downs. You turn on the financial media, and what they're going to talk about is the daily gyration of the stock market. And a lot of times that's noise, and it's not really that meaningful. But what has really been uh, breathtaking this year is how the 60/40 portfolio has been performing so poorly. These are portfolios that have 60% of their money in stocks and 40% of their money in bond funds as a safety trade and getting the yield and the interest from those bond funds. Most investment advisors in the United States put 50% or 40% of their clients' money into these bond funds. And if you go to one of them and they talk with you the first time, they'll often show you back-tested data that demonstrate that such a investment strategy beats the stock market. They can show you that at times that there have been bear markets in the stock market since for example, from 2000 to 2003, from 2007 to the bottom in 2009 during that bear market cycle, that the bond funds went up in value while the stock market fell. During the crash of 2008, Treasury bonds went up in value. Bonds as a whole went up in value, even though the stock market went down roughly 50% during that bear market. So someone that had 40% of their money in bonds saw their bond values go up while their stock values went down, helped to offset the losses. And then if they use a rebalancing strategy in which they sell the part of their portfolio allocation that's gone up to move the money into what's gone down, that helps to smooth out volatility and actually boost returns. I myself believe in that investment strategy. And I've done videos and PDFs several years, like 7 years ago, talking about that strategy. But I never said put 40% of your money in bonds and 60% in stocks, but instead to diversify beyond bonds with commodities, with precious metals, and other things like that, because of what has been happening now. You see, if you look beyond 1980 to the 1970s, that 40, 60, or 50, 50, bonds and stocks allocation did awful because bonds were in a bear market during that decade because of inflation. During times of inflation and rising interest rates, which we're in now and saw in the 1970s, bonds go down in value. And that's why the 60/40 portfolio, putting all the money in bonds has been so difficult. Now we're also in another difficult situation in which gold, since for the past several months, has also been slightly going down, not going down as much as the stock market, but has been trending down too. So it's a very tough time now for just about everyone in the financial markets. But I think it's key to understand the bond market and how it is really what is moving the stock market in this cycle. Let me show you a chart of the TLT ETF, which tracks the 20-year Treasury bond. This ETF is in a deep bear market. I define a bear market as one in which the 150 and 200-day moving averages are trending down, the prices are below them and been below them, and those moving averages are acting as resistance. This has been the case now for the TLT ETF since January. And it's the case for other bonds across the board. Now, today, TLT is trading at a new 52-week low. And bonds as a whole began to fall before the stock market bear market began. They led the way on the downside. When the stock market rallied most recently in June and July, it was coinciding with a rally in the bond market. And then the bond market, as you can see from this GLT ETF, topped out a good roughly 3 weeks before the stock market rolled over. The action in bonds has preceded and forecast the coming action in stocks. And the way things stand now, the 10-year yield is around 3.3%. That yield is likely to go over 4% before this current decline in bonds is over with, because interest rates are likely to go to that level. So we're months away from a real bottom in this downturn in the bond market, and that is troubling for what's going on in the stock market. Now, the stock market bulls don't want to tell you that, because they want you to keep buying stocks. They want you to, and these brokers want you to keep trying to jump in and out and trying to trade, trying to make up for your losses, when the best thing to do is step aside until this decline in the bond market is pretty much over, until the interest rate hikes are pretty much over with. And they'll try to trick you into thinking that it's over when it isn't. You saw that happen between June and July, when all this talk appeared in the financial media about Fed pivot, Fed pivot, Fed pivot. Maybe the Fed will lower interest rates just because the stock market declined. Well, that was nonsense. And the people that were telling you that were completely ignoring the fact that Jerome Powell, the Federal Reserve Chairman, was saying different things publicly in speeches in Europe and in interviews with the Wall Street Journal, and so were other Federal Reserve governors. And what they were telling you was complete, absolute nonsense. But here is one of the real important thing I want to show you, though, is this. This is not just simply a trend that started in January. It really started in 2020. You see, interest rates, bond funds go up in value when interest rates go down in value. And when interest rates go up, the bond funds go down. Well, in 2020, we saw interest rates go down to zero. The Federal Reserve took interest rates down to zero. That created an epic top in bond funds, as you can see from this example. And these funds are never going to get above the values of 2020. That represents a secular top in these bond funds, in an entirely different environment for them, therefore, that we have seen since roughly 1980. This is the most important, impactful trend in the financial markets, and perhaps even the entire US economy. The simple fact that interest rates went to zero in 2020 and therefore had nowhere to go but up. And not only that, but the move to zero and all the QE programs, the busting of the deficit, has helped to contribute to the inflationary environment that we are now in, that is now systemic. They were telling you it was not last year. They were telling you it was transitory last year. Well, it continued and continued and continued to show us that those claims are wrong and that it's a systemic issue. So I do think that we'll see interest rates this cycle, of hikes, likely stop at 3.75 to 4% on the Fed funds rate. That's what the market is pricing in. And then a pause. But after that, over the next 10 years, we could see another rate hiking cycle going to levels beyond what anyone is even considering now. So I see, a move down at some point in interest rates as a temporary move, just as the moves down in TLT had been temporary moves in a long-term upward trend until the peak made at 170. Now, the most widely owned bond fund, as far as ETFs go, is B&D. And as you can see from this chart, B&D is even in a worse bear market than TLT is. The 200-day moving average is clearly in a downtrend, a stage 4 decline. This fund is eating people's investments account alive. The 60-40 portfolio allocation investment strategy has been destroyed. It worked well up until 2020, really up until 2021 in New Year's, when the bear market in stocks and bonds coincided. Something that people invested in this market have never experienced in their lifetime unless they were involved in the 1970s market cycles. Now, I'm including with this video, and I'll put it on my website in the post with this video, a link to this article from Morgan Stanley with the simple title, Rethinking the 60-40 Portfolio Allocation. I think, look, I'm not your investment advisor. I'm not your money manager. I'm not a registered investment advisor either, but I would suggest reading this article very carefully and doing a lot of thought about it. Maybe it's time to abandon this strategy or consider alternatives. And there isn't one single alternative to the strategy, but they have a list here, different ways you can adapt to this change in the strategy no longer working. And they list a couple: being more tax efficient in your strategies. For example, right now, if you've got losses in your account because of the bear market, do some selling of those losses, realize the losses so you can apply them to your taxes next year, or have them on your tax balance for the years to come to counterbalance any gains you may have. That's what Donald Trump did with his investments and how he managed to pay almost zero taxes. That's a story that came out last year. You could operate in the same way. You can do a mix of rebalancing so-called passive strategies and more active strategies. You can go and look for some money managers or asset managers who are more adept at navigating this market environment, have a better understanding of what's going on than others who have not adapted at all and refuse to. And if you've got funds like exchange traded funds and managers who keep claiming that everything is going to go back to normal and are basically blowing smoke like Cathie Wood, get out, sell, liquidate, and diversify through hedge strategies. All kinds of things you can do. And maybe, I have no affiliation to Morgan Stanley, but obviously this is a pitch to contact them, ask them to review your account. But my God, it's time to have a discussion with your investment advisor or some investment advisor. Do something because the game is over. What worked since 1980 stopped working last year, and it's not going to come back to the way it was because of inflation. These are systemic secular trends, and no one's on CNBC is going to give you a tough talk like I just did and advocate making changes. And because they got all these brokers that are advertising. You think Robinhood wants their people to stop gambling on meme stocks when every single time someone puts a meme stock order in, Robinhood makes money off that? No, they want people to gamble. They want people to buy worthless cryptocurrencies, and they don't care if they lose money because they know so many people are now addicted to the Robinhood app, will simply continue to deposit more and more funds in it like they're playing a slot machine. But that's not what investing is about. It's about diversification, but it's about diversifying wisely when you can no longer just use bonds solely as a safety trade. I'm not saying get out of all bonds. I personally own some, but I don't own ETFs investing in bonds. And I actually got puts on some of those ETFs. But I do have CDs. I do own treasury bonds. Right out on a short-term basis that expire fairly quickly because I like to have some. That's what I got in my account instead of cash right now. But I'm not buying 5-year, 10-year bonds, more like 90-day bonds. That's just what I'm doing. You may want to do something else. There's no one simple solution in a market that this is now this complicated. But what's important to do is understand this one key factor is a simple factor that needs to be adapted to and adjusted to, and changes need to be made by most investors in the United States because I know most of them have done absolutely nothing to adapt to what's going on in these financial markets. That's all I wanted to say today. I do lots of videos talking about the economy, news, politics, history, real estate, in the financial markets. You want more financial market videos from me, hit like, then I'll know to make the next one about that. If you're new to me on YouTube, hit the subscribe button and then hit the bell next to it, and YouTube will send you an alert as soon as it is up and for you to watch.